ladies and gentlemen, thank you very, very much. My name is Tony Kiregalandi, your host for the Lego Tech Dialogues. And today is one of those days which you don't want to miss. Today we are blessed by a very, very knowledgeable person in an area that is so elusive to many. An area that all of us need. Today's space is both for the banker and the non-banker. It's both for a lawyer and a non-lawyer. There is no better candidate than the candidate we have today. I want to open this first by giving just a brief introduction on why this topic, Uganda's Lego Tech and capital markets, rethinking unity trusts, treasury bills, and bonds. Now, these are big terminologies to an ordinary person. And it's an area we felt there's a lot of gray space, Louis. There's a lot of gray space. And then somehow the lawyers have created and cocooned in our traditional spaces.
Certainly.
Yeah?
Yes, true.
So we are either discussing a land transaction, family
succession,
dealing with divorce, succession.
That's where the deal flow is for lawyers.
And the recent past, when the oil came, everybody was running to go and do an LLM in oil and gas. You know, last week we were here with Dennis Kusasira, and we were trying to see. I
was on the space.
Oh, sure. Thank you. So, ladies and gentlemen, today's space, like I said, is not only about the lawyers. But today's space is about anybody who wants to do a bit of investment. A person who wants to grow his money.
Deploy money somewhere.
Exactly.
Yeah. And we all have to deploy money somewhere. There's no shortcut for that.
Yeah, so I want us to look at it this way, ladies and gentlemen. You are a younger professional.
Very young in the profession.
In Nakaloke, you run a small business in Jinja. And then you are told, oh, by the way, you can grow your money, and there is this thing called treasury bonds,
government securities.
There is this thing called unity trust, and then there is bills, then there is bonds. So, we are confused.
Yeah, that's true. For a normal person, it's confusing. But
so, ladies and gentlemen, before we invite on my brother Louis Namwanja Chizito, I hope I've mentioned it right.
Yes.
I just want to give you a small brief about Louis. I've known Louis for some time. And Louis is one of those lawyers you want to have if you are dealing with venture capital, if you are a startup, if you want advice on policy, on virtual assets, if you want advice on a fintech, Louis is the right guy for the job. Louis holds a Bachelor of Laws from Makerere University, and Louis has extensively advised in this space. I have seen Louis in battles with the giants. I've seen him in battle with Bank of Uganda. I have seen him, on this discourse, shouting himself hoarse, saying, "Wait a minute, we must have a sandbox for CMA, for Capital Markets Authority." So today we decided to have Louis here, so that he can speak to the lawyers, the non-lawyers, and every other person. Louis, you are welcome to the space.
Yeah.
For starters, who is Louis?
For me, I can't say I'm a simple person. I think I can best describe myself as a person who is very forward thinking, a person who started a small practice with a colleague that is growing 2022, 2021, a person that, if I'm to really summarize as my personality, is I think I'm a very forward thinking person. I don't want to be thrown into a horde of. Actually, one challenge when I was going to university, one of my benefactors told me, Louis, every person I know is going back for a second degree. Even your uncle who is an architect is now in your classmate now at Makerere at that time. I think it was 2014. What is going to make you so different? I told her that, for me, I think we shall see the results when the time comes. But I just told her that I am not that kind of person who wants to be thrown into a horde of very many people. I will, of course, want to differentiate myself in all things I do. So I think the biggest summary I can give of myself is that. I think, basically that's how I can best, for now, that's the best description I can give about myself.
Wow. Before Louis, I take you deep into the dive. Because our listeners are really very, very excited because this is really a topic which touches everybody.
Yeah, everybody. Yeah.
Before I take you down the lane, let us first give us what my friend Zijani normally calls. Give us the starter. Give us the starter. We want to know what is a unity trust. What is a treasury bill, and what is a bond, so that we get to appreciate from first principles before we dive down in there. Over to you, Louis. Thank you very much. Give us that brief, and then we can be able to open the luombo of today's conversation. Thank you.
All right. I think everyone out there can hear me. Good evening, ladies and gentlemen, for tuning into what I'm going to consider a space that is going to be, it's a financial space, but that is devoid of jargon. This is going to be a space of no jargon, no legal jargon, no financial jargon, because those are two industries that like to really embed a lot of jargon into their tools of trade. So today, no. But getting straight to your question, what is a unit trust? What is a bond? Let's begin with a bond. Now, a bond is a simple lending agreement. Now, a bond can be issued. Issuing is selling. You can actually do a bond or issue a bond. Issuing in finance is selling. If you're a government, if you're a corporation, if you are a corporation means a company.
Yeah.
So you can find bonds that are issued by both public and private players. Now, it's a simple lending arrangement. When you hear a bond is an engagement or an understanding that bonds a person who is committing to do something. But in finance, it is a simple arrangement to lend someone money. But a bond does not give you ownership stakes in an entity. It just gives you rights over a principal and an interest. Now, moving down to a government bond. What is a government bond? A government bond means that you have actually entered in, government has committed to lend you money at a certain interest, and that interest will be paid every 6 months. And then at the end, for instance, we have very many tenures of government bonds. We have government bonds are those that are issued above a year's maturity. So you have anything that is issued in excess of 1 year, that's a bond. We have 2 years, 5 years. So a government bond is issued in 5 years, 3 years, 2 years. Now anything less means that you have something called a treasury bill. Now, treasury bills are normally issued in days. They're issued in 182 days, 91 days. So anything less than 1 year's maturity is known as a government bond, a government bill. Okay? So one thing I have to tell the viewer out there is that in Uganda, there are very many components of what you call a government bond. It has what you call a maturity date. It has a price, and I'm not going to all these things. It has a coupon rate. Now, for Uganda's benefit, our bonds, our coupon payments are that payment you get every 6 months. For instance, if the bond has been issued or sold to you as an investor at an interest rate of 17 annually, you're going to get it every 6 months. So they will divide. If it's 17%, you'll get 8.5% every 6 months. Now, can I go into the pricing mechanics, or we shall go into that? Let me go straight to the treasury, to the unit trust. Now, a unit trust, and most of you have been following the developments in unit trusts and what is happening. At my last reading of the Capital Markets Authority last quarter of the previous, I think the last quarter of 2025, they had grown to something called an asset under management of 5.6 trillion shillings. So that means that people are actually looking for where to actually deploy money in real time. Now, what is a unit trust? And like I said, we're not going to go into jargons today.
Yeah.
We're going to try our best. A unit trust is a simple arrangement where you commit to buy into an investment strategy of someone called a fund manager. Now, a unit trust has these players. Before I go into even its description, a unit trust has an issuer, and most of us have heard of someone called Old Mutual. We have heard of Stanbic Securities.
SBG Securities.
I was going to say Stanbic Bank.
Yeah.
We have heard of, as I think, even Sanlam. So those are an example. So now that's an issuer.
Yeah.
Those are also fund managers. So there is an issuer, there is a fund manager, there is a custodian, there is a trustee, and then I'm forgetting one other player. Of course, also the investor. Now, a unit trust is a simple arrangement where you commit as Louis, who is investing, to buy into an investment strategy of someone called a fund manager who pulls monies from very many investors to deploy them into investments. So I don't want to go into what the law says, but the law at its core, it's describing the pooling of monies from investors to actually deploy them onto investors. So if the money is being pooled and then it is deployed into assets on your behalf in a passive manner, there you are entering an arrangement called a unit trust. So what you receive in exchange are shares. So a unit trust arrangement has shares. Now, what you call units. So they pool together monies, deploy them into investments, and then the issuer creates what you call units. So you get money that is invested, and then the unit trust fund manager deploys that money. In Uganda, it's predominantly government bonds, sadly. I think to around 90%, that's where our monies are deployed. So if you are literally buying into an investment strategy, so they're investing on your behalf, and once that unit trust fund manager invests on your behalf, literally what you're now getting in exchange for deploying your money in a unit trust arrangement is something you call a unit. So you receive units. And those units, you have no underlying rights over the bonds that have been deployed on your behalf. So you cannot say that I bought a unit trust and that you ask the fund manager to give you access to your government bonds. That will not happen. That's not possible. So what will actually happen is in exchange, you will get what they call units. Now, a unit trust has something called, we shall go into it, something called a net asset value. Now, when assets are deployed, they actually have value. You get? Now, when you divide the number of units that have been deployed or created by the fund by the number of assets, so you get something called a net asset value. And also it has a price. And we're going to go into the disadvantages of a unit trust and the information asymmetry. But in brief, I hope it's very clear to everyone out there that a unit trust basically is that. And if it's not clear, maybe Tony, you can push back. I just feel like if it's at heart, a unit trust, what you should understand is you are buying into an investment strategy of someone who is deploying money on your behalf. What you're getting in exchange are shares in that arrangement, which are called units. So you, Tony and Louis, become what I call a unit holder. Now, a rights of a unit holder, from a legal perspective, is you just have rights over receiving proceeds, but you don't have rights to the underlying assets where the fund manager has actually deployed that money. Now, the simple technicalities of that is this. Unit trusts have something called, and you have had this metric being thrown around a lot by people at Capital Markets Authority, by SBG Securities. There is something called assets under management. When I give my money to a fund manager, that money is actually not reflected on his balance sheet. What he does, it is actually kept by someone else on my behalf. So what the fund manager does, he has rights to deploy that money, but it is technically money in my name. That's what they call assets under management. They're managing your assets on your behalf. But what they're actually managing are your maybe principles and deploying it in according to the investment strategies of that fund manager. But you're not going to tell the fund manager actually where to deploy that money. So I hope that has cleared up. Tony, you're looking at me in a way that is worrying.
Not really. You have simplified this in the simplest manner anybody would want to understand it. Because in my, I think you may want to mute your mic that side. You have made it so simple because our listeners have been yearning for this, okay? And you have made it so simple that anybody will know that when we are talking about a unit trust, if I'm looking at it from a perspective of somebody from Budaka, I'm looking at an advanced nigina of some sort.
It's like a nigina.
Except here, the nigina has a leader who is managing on behalf of what we have collected.
Yes, that's true.
The leader decides where to invest. Okay? And what you expect as you has contributed in this nigina, in this village club, in this unit trust, is that you expect your profits. That is one. It's the equivalent of some kind of dividends.
Yes. Let's call them dividends.
Dividends for simplicity's sake. So I think for me, you simplify that quite.
But I hope also the bond description has been clear.
Yeah, and I think for the listeners, we pick that when we are talking about treasury bills, here we are talking about government.
For our space's sake, government securities.
Government securities. And we are talking about maturities of 91.
That's a treasury bills now.
Treasury bills, 91.
182 days.
182 days.
Anything below a year, that's a bill.
Anything below a year, it's a bill. Anything above a year, it's a bond.
A unit trust, it's like a nigina. We are now buying into, only that the difference with this nigina is that it has a manager who is deploying our money.
Exactly.
And that money in Uganda, they're deploying it in government bonds. To a small extent, bank deposits, but government bonds. Whether treasury bills or treasury bonds, but that's why now the manager is deploying our money. Now, the manager has the rights to deploy because he's a skilled professional. It's normally a company. Now, that company, in exchange, it is going to give us shares. When they pull our money as investors in this scheme, it is going to deploy all our money together.
Yeah,
that's the power of collective. It's called a collective investment scheme. If I'm to use that.
I hear you.
Now they're going to deploy our money together. Once they deploy our money together, Louis is not going to wake up in the morning and tell the fund manager that I want access to that particular 91-year bill that you have bought for me. What the rights I have over this collective investment scheme is, one, to get proceeds, to get the monies that have been invested as a result of the prudent skill of the person,
the fund manager, so to say.
Manager.
Yeah.
Okay? Now, remember, the money is also not kept on the balance sheet of the fund manager. There is a different balance sheet. Now, because we have a fund manager who is in charge of our nigina, where we are investing our money. Exactly. That fund manager is the one who's going to wake up in the morning and say, according to my professional skill and my years of experience, I am going to put money in bonds. Then I will shift from the 91 year, I will go to the market. Louis Chizito, because you're an investor, your rights stop at having shares that you have been given that are proportionate to the amount that you have invested, and then getting what you call dividends. But now the fiduciary duty is with the fund manager to deploy that money with good skill in that nigina. So an ordinary nigina does not have a fund manager. It doesn't. This now the difference here is that here you are investing collectively, and the pooling of together of the monies from very many investors is deployed by one person. Louis is waiting for his what? His money at the end of the year in terms of maybe an interest of 11% that has been given to me as an investor. So that's our unit trust. And the unit trust, like I was saying, I hope I'm still being heard, it has a fund manager who I've just explained who deploys all our money, and this is also licensed separately. It has a custodian who's normally a bank that is licensed to take charge of keeping our money. It has a trustee. Now, a trustee is a person actually who's supposed to represent all of us investors. Because remember, we are very many. We're all not going to, even when we attend meetings, we don't know the day-to-day running of this scheme. So the trustee actually has a fiduciary duty with us investors to monitor the fund manager and make sure our rights are respected. So now this nigina has very many players in it. This nigina has a unit trust fund manager, it has a trustee, and it has a custodian. And all these people have their roles. Now a normal nigina doesn't have that kind of separation of powers. Yeah? So I don't know. I hope today I have, when our finance experts are explaining these things, sometimes they don't want to go into that simplicity. But I hope I'm being heard and the network is not disrupting us right now.
You're loud and clear. You're loud and clear.
Now, a bond, like I explained, it's an arrangement to lend government money. Normally, our government has what you call deficits. I don't think Uganda has had a balanced budget for a very long time. So if government has not raised enough money in URA, they have other sources of money. One of those other sources is going to IMF, going to the World Bank, going to the IDA. Now that we have Sukuk, we can even go to the Islamic Development Bank, which actually going to the Sukuk a bit later. Yeah. Now, one of the sources of government raising money is what you call the bond market. Now, that bond market has what you call also its rules. And I've explained a bond is where you go for government to raise money from a horde of investors. In other words, government is committing to borrow money from very many people by issuing an instrument. So that instrument is what is allowing government to lend it money. Yes? And our bonds are structured in very many maturities. A maturity is how long government will spend with that money. But every 6 months, remember, of that year, they will be giving you a coupon payment, which is an interest. So if government has not balanced its books and it has deficits, they have to raise money from somewhere. One of those avenues has been selling or issuing government bonds. And in a layman's description, a government bond, you're actually lending government money because government has failed to balance its books. And government, you can lend money, government through what you call maturities. A maturity is a lifespan of a loan that you're lending government in this case. So, like I've explained, treasury bills have maturities of less than a year. That's why you see 91 days, 182 days. Now, the other thing we also have here is we have a bond. Now, bonds have 2 years, 5 years, 10 years, 20 years, and the longer you lend government, the more tax friendly it becomes. I don't know why it's like that, but that's how it is. So I hope we have got the conceptual issues out of the way. So that's how I can explain those two things. I hope now that network is better, people can hear us better.
Well, thank you very much, my friend Louis. You have broken this into pieces. Ladies and gentlemen, we are listening to our panelist, Louis Kizito. Louis Kizito is the managing, is a partner with the Pentagon Advocates, and is an expert in virtual assets. Is a consulting lawyer for fintechs. Louis has advised venture capitalists. He has a lot of interest in commercial law, and he has written equally a lot. Those of you good at reading, you can't miss Louis' article on some of these conversations we are having today. He has had the push and shove, the fist fight with Bank of Uganda, with in a good way, by the way, in a good way. So I said, look, we need to have these things work in the right way, So, Louis, thank you very, very much for taking us through bonds, bills, and trusts. I can assure you, this is a gray area. And many times our listeners, our lawyers, our non-lawyers invest in this thing because they are being told that, ukateka mu unit trust, ojafuna.
11%.
You're going to fund 14%. So somebody sits back and said, oh, wait a minute, so I can just put my money there and wait, and then if I need it, I can pick it. But we don't understand the industry. We don't understand the industry. And I think for me, that's why this conversation is really, really very, very important. And just right there, because we are discussing, legal tech dialogues. We are talking about capital markets and rethinking unity trusts, T-bills, and bonds. This space prefers what is called reverse thinking. And that's why you can hear the topic is rethinking. Yes, we have these unit trusts, we have bonds, we have bills. But the question is, are we doing the things the right way? Are we protecting somebody from Nakaloke who has sold his cows and has been told that when you invest your money in a unit trust, okay, you are on a safe ground, okay? And that's why this conversation is really very, very important for us. And I think that takes me to my first question, having given us the background of all these. From where you sit, apart from these legalese, which we have agreed in principle that we are not going to, what is that single barrier, to that investor who is deep in Namaja, deep in Nakaloke, deep in Chanamukaka, who would want to invest in these bonds? In your experience, from your expertise, from where you sit, what is that single barrier, which you think that I think this is a barrier?
One of the issues I think is a barrier in this space is, I'm going to group them into three. Yeah. There is awareness and how to create that awareness. Then there are the technical issues of how our financial instruments are structured and how they're regulated. Then the third would be, I'm going to go into what you call market access, how to enter, the ease of what I would call information asymmetry. Now, the first, when you read the Capital Markets Authority report, they normally release what you call quarterly reports every quarter. And give it to them, they're really industrious when it comes to releasing reports.
Analysis of our institutions.
They really release reports, and their reports are, at least on the surface, they're okay. So when my reading of the report of the last quarter, it demonstrated that the unit trusts are growing, at least the unit trusts. We shall go into the challenges of the bonds shortly and how they are becoming problematic for someone to actually understand.
I was checking, and unit trusts are holding portfolio up to 4.5 trillion.
No, actually it's 5.6 trillion.
Goodness me.
I think by the end of this year, it's going to reach 7 trillion. of money that has been invested. Now, let me tell you another thing about unit trusts. And the bankers should be afraid. And if you bank on this space, you should pay attention. One of the reasons why bank deposits are being eroded very fast, it's because of the exponential growth of unit trusts. Now, that is a metric that I think the central bank hasn't looked into, but that is why now even banks are now rushing. I think they've noticed. They are rushing to have their own unit trusts because they feel that their deposit base of people just having money lying redundant on accounts is, even when they're saving deposits, they feel like they're not offering as much as a unit trust would offer. Get? So Stanbic Bank under SBG Securities has SBG Securities unit trust scheme, and the fund manager is SBG Securities. I think even I know about 3 banks. I'm forgetting the other 2, but
I think NCBA too.
Yeah, NCBA, even StanChart, they had, and of course they're coming up with dollar unit trusts. So the longer unit trusts grow, they're actually going to encroach on the deposit base of banks. So the banks are also proactively looking into having their own schemes. But now this is the challenge of accessing markets and financial instruments in Uganda. The population has not yet appreciated deeply. Even when there is exponential growth, you may realize that the growth is actually concentrated in a certain population. Urban-based population, Kampala, maybe Mbarara. It's concentrated in a certain, there's a concentration of investors. So the investor base has not been fully diversified to someone who's down there in Kapelibyong, is it? I don't even know how to pronounce it. Or maybe down there in Mitoma.
Exactly.
You will find a few, but there's a concentration in urban areas. Now, but you should give it also to them, to the Capital Markets Authority. They have actually gone out there and they have tried to move with the fund managers to actually create awareness. So you will find that of late, even our circles are actually deploying our monies in unit trusts. Yes, of late our circles. Remember, our circles had this preoccupation, this dangerous addiction of piling on real estate.
Exactly.
And actually the investment advisors were advising our circles to actually look for what you call liquid instrument. A liquid instrument we avoid, we can't avoid legalese, but we're just going to, and financial jargon, but we're going to try to break them down today.
Exactly.
Now, a liquid instrument is what you can sell easily without incurring losses, and you can sell it very fast. Now, a government bond is liquid because once you're going to sell a government bond, there's already a buyer who can pick it up. There are issues in the secondary markets where you can actually dispose of your bond, but at least a government bond is liquid. Within 48 hours, and banks actually have a mandate to even acquire it from you in case there is no buyer. That creates its own dynamics of pricing and widespread, but at least there is someone. Now, real estate is not, yes, it is an inflation-proof asset, but it is not liquid. You can look, even when land is prime, like the kind of land we have in Kololo, even in Nakasero Road around here, if you're going to get a buyer for it, chances are high you might give it away at a very giveaway price.
More especially if you're on the run. You badly need the money now.
Exactly. Now, that is why our circles of late are deploying money in these instruments, you get? So, for a small person who is down there in, let us say, Western Uganda, they have one of the largest circles lately. They're even rivaling Wazalendo.
I was in shock.
Yeah. So, now they're being told to actually deploy money in liquid instruments, and fund managers are coming now up to actually advise our circles on how to deploy our money. If you have a small investment scheme that is on maybe in your workstation, you're not going to buy land. You get? So for me, what I would think the problem is for our financial instruments and financial sector, these capital markets instruments, is awareness. These things appear to be complicated, and the investments are largely concentrated in urban English-speaking people. Because now even me, Louis, if you tell me to go to my village somewhere in Entebbe, Katavi, to explain to someone that a unit trust is in Luganda, and in Luganda without putting any English there, I would struggle.
I know.
So for me, I would think that now that's part of the challenge. Now the other challenge, we have also structural issues on how they are conveying these assets. Which medium? Are they technology enabled? Are they fit for the rural environment? Then the psychology of the population, it's preoccupied and predisposed to real estate. If you tell them to go to a financial instrument, you are overstretching his imagination. So that is why the biggest barrier actually here is the culture. It is changing, but it is the culture. And that culture, when people realize that they need to deploy money in assets that can be liquid or liquefied easily without incurring losses, then I think they will pile again onto the unit trusts, onto the financial instruments. So if I'm to group the challenges of these I call them financial instruments, is the culture of the population. We are still predisposed to real estate. We are piling so much, even on circles that are actually holding large amounts of money. They're just deploying it in land. And of late, you have been seeing these debates. I don't know. I think you've been following them. Real estate versus bonds. Have you been following those Kakande debates with Kakande? And so that shows you that the mindset change has to begin at least with that debate before we proceed. So that's the biggest challenge. The mindset change, the concentration. The investors are concentrated largely in urban-speaking, English-speaking populations. But it is changing. Though the assets are growing and they're eroding the deposit base of banks, and banks are also saying, guys, we should wake up and also keep money in-house through creating our own schemes. So basically, those are the challenges. Information asymmetry, the culture of the population. You know, when you look at, actually, Uganda is still largely an agrarian economy. Our mindset, even for the elites, we are still at that level. But I think now that oil revenues are going to flow in, I'm not.
I love how Louis polishes our agrarian. In short, and those are actually me.
But for me, Tony,
Yeah.
to answer your question,
Yeah.
is the culture, but it is changing, and then also these things are still new. By the way, capital markets, we are 25 years into this space as a country, by the way. Because when you look at the Capital Markets Authority Act, it was actually brought here not because the government wanted to do so much. No, these were some of the IMF moves to privatize. No, I think you remember the assets of Stanbic Bank and how they had to get them privatized. They had to go into the market. So this entire arrangement is 25 years old. The Capital Markets Authority Act, actually now the authority is celebrating 30 years of existence. So it is a work in progress, but I think it's going to change. Where we're going, it's going to change very fast. And the lawyers who are in this space, in advisories, they're actually going to make some big sums of money. The lawyers actually are making $1 billion. I think one of the law firms that were advising the IPO, which are going to the IPO, what it is, when the government, when a company is actually issuing shares for the first time, that's an IPO. Now, when you look at some of the law firms that have actually structured these deals, they're counting billions and above, at least a very minimum of $1 billion. So the culture is, though those transactions are rare, but if you're lucky enough to get an IPO advisory and you're the legal advisor, you're counting in excess of $1 billion. So for me, those are the challenges. The challenge is our culture is still we are developing this culture of financial instruments. And then secondly, the concentration is largely in English-speaking people who have access to Twitter, who have access to an English-reading newspaper. So those are the big challenges. We shall go into the structural challenges of the pricing. But for now, let's.
Thank you very much, Louis. Ladies and gentlemen, we are discussing legal tech and capital markets, rethinking unit trusts, bills, and bonds. And you put it in a very struck naked approach. Where you look at the barriers. But I also would want us to look at it from the perspective of the technology bit of it. I kept asking myself, Louis, from where I sit, we are a tech law firm, and a number of these basics, and I actually do not know, maybe for you who has been a warrior with some of these institutions, I do not know why a person from Budaka who wants to invest, to buy a bill, okay, has to go through this, post-era, the pre-colonial era, so to say, because we are dealing with the Gen Zs. The lawyers you'll find on this space, people like Timothy, people like Gloria, for example, the lawyers are in a completely different generation. They do not want to move. And these investors and whoever we are talking about, I am not in the comfort of, I'm not comfortable Mudak Julius, the banker, telling me to move from here, to go to NCBA, to go to where, and fill in paperwork. That himself is a barrier. And my question is, with the latest technologies, why can't, from where you sit, why isn't and these institutions not taking up some of these technologies? Because I would imagine with blockchain technology, we should be in a position that in my sitting room, in my bedroom, I can be able to tap on my phone, 1, 2, 3 buttons, and they are able to verify. AI should be able to verify my NIN number, and my NIN number should take you to my details and confirm that this is Galandi Tone Chire. Yeah? And then should be able to move an extra mile and be able to now be able to do the online purchase and stuff like that. From your perspective, what do you think is affecting growth in that area? Sort of take you that lane, but these are Lego Tech dialogues, and we try to promote as much as we can digital transformation. Yes. Yeah.
When you're discussing finance, you can't detach it from technology. I was telling someone, I think a colleague yesterday, that there are 2 aspects or industries that have actually adopted technology faster than any other areas, industries. That is defense and finance.
Wow.
When you look, the biggest breakthroughs have been embraced first by the defense industries, the defense contractors in America, all worldwide, and then Wall Street. That's where the cutting edge technology actually are first deployed. So you cannot really detach actually technology from this discussion today. That's why the legal tech dialogue should actually host as much or as many defense and finance professionals as possible. So now going to your question, why are our banks or financial institutions reluctant to update what I call market plumbing? The Americans call it market plumbing is the underlying infrastructure that delivers you financial services. For instance, if you're going to invest in government bonds, you'll be told to facilitate or go through something called an SCD account. Now, an SCD is a depository that is holding whatever you're going to invest in. Now, that is what you call the underlying invincible infrastructure. Now, why are our banks, financial intermediaries, why are they very slow in Uganda to adopt what you call cutting edge technologies? I will tell you, we have just finished a regulatory impact assessment for virtual assets. I think I sent you one of the documents.
Yes, you did. 8 May?
Yeah, just last week, 21st actually.
Exactly.
Yeah. And I would tell you that when we're discussing blockchain technology, all of us were learning. Even the bankers in the room, all of us were on the same plate. We're all learning. And the problem is, as a society, we're not very forward thinking. And I also think the bank, I'll give you an example. There's a friend of mine, I'm not going to mention, let me mention the name because he's known. He runs one of the blockchain dev events, South Africa, Uganda is. David came to me and wanted to go to a major bank to show them how they can track what you call crypto flows within the bank. Because there's a bank called, let me not mention the bank, but there's a bank that seriously wanted to look into crypto flows and how to help government to see how visibility into how crypto assets are moving and how they can get onto the radar of banks and how banks can, that bank can actually give government visibility.
When you talk about crypto, we are talking about virtual assets.
But we're going to go there. I'm just explaining to you why we are very slow. Now, this bank actually had to seek audience with one of the key stakeholders in government. But actually, the reason why this gentleman, David, came to me is that he thought I knew someone in the finance who the bank would connect with to explain to them why it is important that banks should not be left behind. And this is a bank that most of our banks are normally subsidiaries of big global conglomerates. Unfortunately, the meeting did not happen. The big government official was a little bit jittery. Like, what is this? What are you doing? So the meeting just fell through just like that. So the explanation I got from him was, I think the government officer, one, he did not understand or appreciate what the bank wanted to engage him with. And that now creates a cultural problem. As a country, our culture, we're not as forward thinking. I keep telling people that Uganda, there's a friend of mine, not a friend, someone I know, who runs a Ponzi scheme. He told me, Ugandans are 1,000 fools plus one. If you want to run a scheme of quick money, just wait for Ugandans. So he was telling me that as Ugandans, we're not very forward thinking, and we're not very scientific with how we make money in this country. We just throw money somewhere and hope it multiplies. We're not very scientific. And you will find exceptions to the general rule, but they don't make the average. You can't average them out. So the problem why technology is not being embraced by large financial institutions, it's because I think the policy levers are moving very slowly.
Yeah.
For instance, people who want to deploy even things, for instance, of RegTech, and you have talked about integrating nearer systems so that you don't have to throw your name all around the place or throw your name all around, or throw the same documentation everywhere, physical, and you're using the same nearer. It's, I think, the fragmented nature of how we are handling our data, even in the financial system, is not pleasant. I'll give you an example. NSSF recently, there's a friend of mine who came to me and had an affidavit, and NSSF was trying to tell him to get an affidavit to confirm an age that they have in the NERA system, that they confirm themselves in the NERA system. So they wanted not an affidavit, sorry, and I'm sorry for this, it was a statutory declaration, not an affidavit, not a deed poll, it was a statutory declaration. But I asked, why do you need it? Because if I give you my national ID and you have it, as NSSF, you can actually confirm that if my birth is 1994 or 3, you can know, without me swearing, a statutory declaration. But they had to go that far. So the thing is, I think the culture, I'm going to link it onto the culture, because even when you deploy a tech service solution that is above or way above its time, you will notice that even the uptake will be slow, because again, the policy levers are moving very slowly. And then even when you want to deploy it, you will find that you might be out of place, or maybe you may be too early for your time. So sometimes even the market participants who are offering unit trusts, who are offering collective investment schemes, are also in a wait and see mode. So a technology that does not make sense for them and getting them more clients, they might wait a bit to actually deploy it. And even when it helps them, they might need to pull a few policy levers here and there, which are moving very slowly. So they rather be in a wait and see mode and balance out the interests of government, market participants. So that is the challenge. So unit trusts, you give it to them. Their friends like Zeno. Zeno is also a unit trust. I've even forgotten to mention them. They're trying to be tech savvy. At least they're not going to burden you with all the documentation, because for them, how they actually deploy their investments a lot, they deal a lot with the tech savvy solutions of, they have a portal, they deploy assets remotely, they have certain ways of deploying assets that don't necessarily need you to actually go to their offices. But when you look at them in the market, they might be not even the market leaders as yet. So I was telling someone at Zeno that I think you're ahead of your time, but they told me, Louis, we have to do this. But they are doing fairly well. So I can't say the technology has not been deployed well. It's moving slowly, because as a population, we move very slowly. So for me, that's how I would really sum up technology uptake, deploying it. It's just, we are slow movers.
Wow, ladies and gentlemen, we are listening to Louis Kizito Namwanja. Louis Kizito Namwanja is an expert on finance, so to say, to group it as a whole. He has greatly advised on venture capitals, fintechs, and he's the right guy for the right job. Thank you very much, Louis. And I think for me that takes us to, this space accommodates both lawyers and non-lawyers. We started it, by the way, previously for lawyers. But over time, you cannot separate the lawyer and the client is the one out there. Yeah. So I would want us to, I would want you to simplify this for the non-lawyer who is interested in this space. Is I would want that expert to simply take me through a process, because I have my money, I am undecided. Should I buy that plot of land in Bukerere, or should I invest this money in a unit trust? And if I'm investing it in a unit trust, what is the traditional practice? What am I supposed to do? What are the... let me get a picture. I have my money. I don't need first to go to the bank. Now that I've listened to Louis, I can now be able to go that this is what I expect to go through.
Okay. Now,
Yeah, often
if I'm to
raised.
get your question right, I think you're asking of how best can we the processing of deploying our money either in a unit trust or in a government bond.
Exactly.
Let me start with the government bond. Now, and I've been complaining about this, but let me first go through the process. Now, if you want to invest in a government bond, sadly, you have to go through a bank. If you have your 100,000 shillings, which is the minimum for you to deploy in a government bond, you go to a bank, maybe Centenary Bank, maybe Stanbic Bank, and you ask, and even some of the employees there may not know what you're talking about, but you have to ask specifically for, I want to invest in government bonds and I want an SCD form, a Securities Central Depository Form. You have to ask for it because even me, Louis, one day I went to a bank and I told the teller, I want to buy government bonds. And the lady asked me, Bichev, you. And please, I'm not being bad to people, but you can go to a branch, for instance. If you go to a branch, a regional branch of Centenary, for instance, somewhere, even around Masaka. Okay, Masaka, people may think I'm eating on Namere. Let's leave Masaka. Somewhere very far from Kampala, and you want to tell people that you want to lend government. Not everyone will quickly help you. So you have to insist and ask for a Securities Central Depository Form. Now, there are two forms. Now, there's SCD1 and SCD2. Now, SCD2 goes more into secondary market things, but you ask for SCD, where you're, especially if you are sure your government has announced and there's an auction, and maybe you want to partake in it. If you have your money above 200 million, which is a competitive bid, that's what they call. It's called competitive because now there you have capacity to move the price, and I'm going to go into the nitty-gritty of that, of how the amounts you have in your pocket and you're willing to deploy can move the market. Now, the minimum amount you need to deploy in a government bond, it's 100,000 shillings. You go through a bank and you ask that bank that you want to open an SCD account. They will give you those forms and you will put your name, of course, your name, the KYC, the bank where the account where they're supposed to throw your proceeds in case government has paid out coupons every 6 months. So that is, for bonds, that's the short process. But you have to be careful and please get it. Oh, by the way, we should say one thing, people. This information we're giving here is for education purposes. It's not legal advice or financial advice. If you want financial advice, please go to your financial advisor. If you want legal advice, go to your lawyer. But we are just for education's sake, we're putting this out there. So you go to the bank and ask for an SCD form and you fill it accordingly. And you actually need to be guided on how to fill that form, because certain banks might actually trick you into signing a form. It's Form 2 and not Form 1. So you have to actually seek advice of a professional, preferably an investment advisor, who can actually help you on how to fill that form and which form to fill and even when to buy. But you go to a bank, ask your investment professional on when to actually get you that form. Now that's for government bonds. Now that's a simple process. Of late, we are having tech-enabled situations. Uganda Securities Exchange actually also opened up. I have issues with Uganda Securities Exchange model, but you can also use it. They opened up a portal. Now that portal, they have it it's an online portal. You can actually use it to fill what you call your orders to process your bond. So there are three ways. The more direct way is through a bank. The less direct way, because remember, Uganda Securities Exchange doesn't have direct access to the government bond market, and we're going to go into the technicalities of that market a bit. So you can go through that portal. They have an online portal, and you can process orders. And then there are also other people who are dealers. There are people who are dealers, and they have a license from the Capital Markets Authority. Now, those dealers can also help you process an order. And I'm going to go into the dealer situation a bit. Until we made a lot of noise, and I think you rightly mentioned that I was making a lot of noise in this space, no bank was actually licensed as a dealer to process orders. When you went to a bank and you asked them, what is your license? What license are you using actually to process orders of the public in this market? They didn't have any. Actually, they were saying they were regulated by Bank of Uganda. But then we told them no. The person whose licenses people who are investing people's money on their behalf is someone else. And what also helped us is that the Auditor General also raised an audit query in 2022. And he was questioning why the Capital Markets Authority had not licensed banks as dealers. So we had a situation where banks were unlicensed and they're processing dealers. But as we speak, there are 8 banks that are actually But you can even go through any other bank. But for now, I know of 8 banks that have direct licenses from CMA to process orders. And those orders are actually processed for you. And then at the end, I think within 24 hours, you will have your account set up. And remember that account is opened up at the bank of you. That's not a bank account, please. When you go to a bank to open up an SCD account to actually buy government bonds, the bank itself is going to process that document at an account in Bank of Uganda, because that depository is property, sadly, of the central bank. So even the bank is an intermediary. So when you're opening up an SCD, a Securities Central Depository account to buy government bonds, you're not opening up another bank account, please, with your commercial bank. You are opening up an account on a platform that is hosted by the central bank. Let's get that out of the way for a normal listener. Because you might think by going to a bank to buy government bonds, you are actually you're opening up another account with your bank. No. The bank is another intermediary of actually the central bank. You get? So that's a simple process. And they have 2 forms, SCD1, SCD2. Though there are other channels through the Uganda Securities Exchange, they have a new portal. Also, these are other dealers that are not banks, but are also in this space, provided they are licensed. So that is a simple process. Now, for unit trust, the process is a bit tech-enabled. For unit trust, you can go to our friends, and there are quite a number: Old Mutual, Sanlam, SBG Securities. They have offices, and you tell them that you actually want to open, or you want to open an account on, or you want to invest in unit trusts. Now, a unit trust, of course, they will also ask you for a KYC. You have to fill in your name.
Our listeners, KYC basically is know your
customer. It's an AML, FIA kind of thing. Yeah. They have to know you. But for unit trust, the process is not actually long, because now remember, here you're not dealing with government directly, sort of. Here you're dealing with people who are slightly aggressive and they want an uptake. And for unit trust, actually, you can be onboarded through even people who are more promoting the product. Yeah. So if you know the person who is offering, and the biggest market player with the biggest market share in the unit trust space is Old Mutual, sadly. I think they should be owning, they should be responsible for about 80% of the assets under management, Old Mutual. But I'm not going to bias anyone. You go to a fund manager, and their offices are quite open. And they also have, lately, some of them even have, now, like Zeno, my friends at Zeno, they have online platforms where you just have to go to their website, type in a few things, and within 24 hours, 48 hours, your account or your proceeds can be deployed accordingly. And you don't need to actually ask. But if you want the detail of a unit trust, they have something called an information memorandum that they file with the Capital Markets Authority, what you would call a prospectus. Though our law does not say that the unit trust should have it. A prospectus is a document that discloses the financial disclosure that someone is supposed to make before he offers you something to invest in. So for them, they don't have a prospectus, but they have information that they put out there, an information memoranda that is normally filed with the Capital Markets Authority. So you can write to the Capital Markets Authority and say, I am going to invest in X and X unit trust. I want to know what is the information, the memorandum, what offer documents, or they call them offered, in capital markets, that word is used a lot. An offer document is a document that actually discloses the information to an investor of who the fund manager is, who the custodian is, the net asset value, the unit trust. And remember, there's something called prohibition against backward pricing, where if you're going to invest into a unit trust, they're supposed to redeem if at all you want to cash out, they're supposed to redeem you at a price that is forward-looking. If the forward-looking price is bigger, they're not supposed to redeem your holdings at a price that is the previous day and lower. So if you need all these details, first of all, write to the fund manager. He will disclose this information to you. And maybe for security, you're doing your due diligence, you write to the CMA and you ask for the certain offered documents. And a unit trust also has something called a trust deed. By the way, we even forget, this is a basic thing. Because it's a trust, by the way. So they have a trust deed. You can actually also ask for it, though I don't know very many people have asked for it. But you can ask for the trust deed, read through, and why is it important? These unit trusts have lifespans also. They don't go on forever. Like you can find a unit trust goes on for 10 years, it mutates. So the shorter the lifespan, the more expensive. The longer the lifespan of the unit trust, the cheaper. So that is why it's also very important to find out on this nitty-gritty, the trust deed, the pricing mechanisms, cashing out. So they have certain documents they file with the CMA, the trust deed being one of them, the offer documents that disclose the net asset value, how they redeem their holdings for investors. So for unit trust, it's a little bit straightforward. But what I should say for unit trust, there is a bit, because we're not so well versed with this industry. And I also don't blame the fund managers. I really don't blame them. It's not for them, they don't give you all the information. It's upon you to ask for it. Yeah. Okay? So as a unit trust investor, ask for utmost disclosure. Don't just wait for the minimum invested amount is 100,000 shillings and then you deploy. Just because it's 100,000 shillings doesn't mean you are getting the units for that unit trusts or at the right price, or the shares at the right price. So the pricing, and at the end of every day, unit trusts, the prices are computed once at the end of every day. Unlike a stock exchange where you know the prices every day, every hour if you really have to. Here, the prices are put on the websites of the fund managers, or sometimes they even send them via email. And CMA also has a portal where you can go to check for the net asset value, which is the price at which units can be held or shares can be sold to you. So all this information, my advice is unit trust holders or unit trust investors, we don't get enough information because we don't ask for it. And any finance professional, that's what he wants. No one wants to actually deploy money to a sophisticated investor, because if I am going to deploy money to sophisticated investors, chances are I will not make as much money. That's why that information gap, it is your duty to actually cover it. So the processes, if I'm to really streamline them, for the treasury securities, you have what they call SCD accounts that are open through the dealers or through the dealer banks, and then the bank processes that information with the central bank. I think that process should also be automated a little bit much better. So for the unit trusts, you go to the fund manager or a person who's running a collective investment scheme or unit trust, and then you ask when you can invest. And in my view, I think it's even much easier. A unit trust is easier because these people, they move fast and break things, unlike our bond market people. They move a little bit faster, so you don't have a harder problem. But of course, your national ID is a given. You need it. You need to be known. Your bank account you should have at least a bank account where the money will be deployed or the proceeds will be sent to, and it should be a bit active. And you should at least be of certain sound age. I don't think they will accept someone under 18 unless you're going to hold the. But I think actually under 18 they can hold by the assets, but it's technical. But even people under 18 actually can, though it is a bit technical because what they require is 18 and above. But if you're a parent and you want your son, child, daughter to have an account, they can actually do. Though it is a bit technical, the process there is a bit, the forms they will have to be a guardian. Sometimes you may even need a guardianship order. So our family law also plays a part there. So for a child who is below 18, the technicality is a bit longer because the Contract Act and the ability to contract is above 18. Though even minors can hold unit trust. But you have to, even when you're the legal parent and you're the biological father or mother, you might need to get a guardianship order just to demonstrate that the child, you're holding these unit trusts or bonds on behalf of a child. So it becomes a bit technical. It's not, much as the law says that such instruments should be deployed to people above 18, sometimes exceptions are made. If a guardian or a parent can go the right mile, get the requisite document, and I would think a guardianship order, because remember, you're not going to dispose of the properties of a child without a guardianship order. That's the basic family law. So
it's just right there, Louis, you bring in a very, very, I think for me, my take home for this segment of your conversation is, number one, as an investor, as a lawyer who is advising a client, there are basic things which you don't sweep under the carpet. Number one, a unit trust is a trust. So one of the key things you should be interested in is getting a copy of a trust deed. And you ought also to know how this unit trust runs your money. Instead of just carrying the money and I've talked to the bank, I says, fill in here, sign here. They even highlight for you by the way. They just simply sign here. sign here. I mean, like we are signing the 1900 agreement.
And that's what most of us do, by the way.
Exactly. And I think for me, this is an eye-opener as lawyers who are advising clients. It is very important that if a client is walking into your office and is seeking your legal opinion, your legal advice on how he should be able to invest in a unit trust, basic things first. There is need to know, to get a copy of the trust deed. It's within your mandate. And you also bring in a very, very key thing, and that is the automation bit of it. In your experience and from where you sit in this whole process, where is that particular area which is badly broken, which in your opinion needs automation? Because when I say that, is it the settlement? Is it the custody? Is it the KYC? Is it the onboarding? Is it the trading? That if somebody asked you to advise Capital Markets Authority, what are those areas? You know what? Honestly, we are in the 1900. We ought to do this here. We ought to do this here. We ought. The reason I'm posing that question is I can tell you we have policymakers who listen to these conversations. They do. They may not deploy them, like you've shouted yourself hoarse, but in the background, they sit back and say, I think, wait a minute. I think I had something like this, and I think if we did ABCD, we must continue preaching the gospel until they get saved.
They will. Anyway, that one area I feel should be automated. Let me give you a brief history as we're going to that. Let me give you an example of how the evolution of how people used to invest in government bonds. On the weekend, I was at my mom's place just recently, and I was going through old newspapers because I come from a family where if you go, people used to buy old newspapers and place them somewhere. So I was just doing a few cleaning. Then I landed on a paper of 1997, and I think the headline was Princess Diana. I think that was the year of Princess Diana.
Yeah, exactly.
So I opened, I think it was New Vision, yes, and I opened the last page, and I was surprised. I hadn't seen it before, but there was an advert of how to invest in government bonds. Wow. And let me tell you the evolution. When I saw that thing, it actually brought me up to speed. I was like, wow, I've been making noise, and this is how far we have come. Now, for government bonds in 1997, when I read that advert, there was a whole capital markets and financial department within the central bank before we had the Capital Markets Authority as a standalone. Now, if you were going to buy a government bond, you had to go to a bank and there were envelopes. Now, those envelopes were even signed. They even had indicators these are government bonds. Now, you would actually put in your bid, your offer, and you put in that envelope, and then they would physically be transferred to the Capital Markets and Financial Department at Bank of Ghana in 97. I don't even think I was understanding anything at that time. So at that time, they would issue something called a bearer certificate. A bearer certificate. And we're going to go into these things of bearer, as we're going into issues of tokenization and automation, we're going to explain what a bearer financial instrument is. Now, they would offer you a real bond bearer certificate that actually proves that Louis, you bought these bonds, you went through the process, a physical process, by the way, of getting that envelope, putting that bid in there, and then those envelopes are physically transferred to that government, the Bank of Uganda Department of Capital Markets and Financial Markets. And then in exchange, you have to go to your bank to pick what they call the bearer certificate. And I wish I had come with it, but that, I think I'll send it to you, for record's sake. I've taken a picture of it. Sure. I'm going to send it to you to show you. That was the process. It was very manual. Yeah. They even issued you a certificate. Yeah? Now, fast forward to 2002, and when I saw that ad, I had to ask one of the senior colleagues in the financial markets department, I think at BOU. Fast forward around 2001, 2002, 2003, 4, 5, and I think towards A6, it changed. Bank of Uganda now did something called dematerialization of physical bearer certificates. As a lawyer, this thing might be very important to anyone who is listening, but I'm going to explain it and break it down. Now, dematerialization means that they're eliminating the need for you to not only go and process the envelope, get that envelope at the bank, put in that the bid that you're asking for to buy that bond, and also in exchange giving you what they call a bearer certificate. So they eliminate physical certificates, and for you to prove that you have a government bond, you needed a certificate. They eliminated that. Now, what they do now is they eliminated what they limited the physical share certificates, and now your bond, if at all they're going to prove to you that you have it, they do something called a book entry. So your bond is recorded into an entry. It's a book entry. So in other words, ones and zeros are reflected in a computer system somewhere, and they can be printed for you, and then they will show you that, Louis, here are your government bonds. They are in an online digital system somewhere. But by the time we got there, other counterparts of ours had been there about 30 years earlier or even 20 years earlier. So now that entire process of eliminating physical bond certificates is what was one step towards electronic handling of orders or processing orders in the bond market. Now that Securities Central Depository holds those bonds in electronic form, dematerialized. They've actually removed their material nature. That's why they're called dematerialized in book entry form. Now that's how we have gone. But the process can actually be made much better. And why am I saying this? As we speak, there is no need why I will have to go to a bank to fill in an SCD form when a bank has an online portal.
Exactly.
Why do I have, and I've just explained to you, some of these branches don't even know what, some of these employees are not even brought out up to speed. And if you're a bank manager, please, I think you should take this feedback. I'm not going to mention the banks, but you should take this feedback. I think you should do more training to your staff, your low-level staff, about processing government bonds. Maybe the tellers, maybe even the customer care agents you might have, because most of them are not even well versed with what the SCD forms and where to find them. Sometimes you may even have to move from a branch that is as far as that is on the outskirts of Kampala to come in the central business district just to convince an employee about a security center. In some banks it happens, not in all banks it does. So in the day-to-day age where you are actually dematerialized certificates of bonds, and now they are in book entry form and they are accessible electronically. I don't need a bearer certificate, I don't need a bond certificate to prove ownership. I can equally process my SCD on an online portal. And then that order, I can actually get confirmation, even from the central bank directly, sometimes even without going to the bank, that you have your bonds and here they are, without going through the bank sometimes. Get? And also, the world has evolved to a point where we no longer need financial intermediaries as much as we needed them. And this is not a bad statement for lawyers to lose business, but in the world where you have online instruments where you can process orders, you can process whatever you want in the financial markets, there's no reason why it should be a mandate to go through a bank. And the bank should process, even some of these intermediaries we know, like even the United States Exchange, they don't have direct access to that platform that hosts the government bonds where we buy them from. They will also have to go through a bank, because remember, and let me explain this a little bit more, because now here we're going into technicalities that I need to break down a bit. That Bank of Uganda platform has what you call depository participants. People are supposed to process orders on it directly. Okay. And the mistake Bank of Uganda makes is to think that only licensed financial institutions should process orders. And yet these things of capital markets don't deal with banks at all. They deal with things like a dealer, like even you and I can wake up in the morning with the right, if I have 70 million today, you and I can say we want to be dealers. And it should be our right to actually access that platform to process orders on behalf of others. Why should it only be banks? Now, we're in an age where financial intermediaries should not rigidly be, we don't need them strictly the way we used to need them, but it should be a bank. If, Louis, I can deploy an online portal and I have the capital requirements and I've been licensed by the Capital Markets Authority, and my processing and my tech, my order flow can work even more in a much more convenient way, why should I not actually have access to that platform? Why should I get those forms from a bank? Okay? Because they're the guys who have the direct access. Even people who are licensed by CMA, they have to go through those banks to process your orders. I'm not going to mention them, but they do, because they don't have direct access to the Bank of Uganda, what their depository. So now automation can go a long way by democratizing access to that market. And one of them should be privatizing and removing that depository from the central bank. I have told people at Ministry of Finance this, and even Bank of Uganda, and even I think it's called a Fixed Income Market Committee that is looking into the chaos and the disorderly nature of this market. They seem to be moving slowly, and this is my explanation. Once you move that depository out of the central bank, to any person, okay, even though the central bank is still in charge, but you can still have it out. And if Lewis is going to process an order for bonds, it can, the auctions, the coupon payments can be done in that element, in that depository that is outside the bank. But once you keep it with the bank, this is what it means. You cannot optimize that market as much as you want to, because as a person who is an innovator, you are kept out.
Exactly.
And yet the biggest ideas come, and we have seen this in Wall Street. We have seen this in the London Stock Exchange, because even in London, the Central Bank of England, the Bank of England, is not the one that is housing that depository that is holding the instruments that Lewis is buying. So once you move it out, it becomes easier for Lewis and other innovators to actually connect to it. And I'm told of late, even the United States Exchange, the United States Exchange also has a depository.
Really?
Yes, because remember, when I am buying shares in a company, they're held on that platform. What the exchange does, it's just matching orders. It's like, Lewis, who wants to buy this from Lewis? And they're just matching. But the whole assets are held on that depository. But now, because of the battles that have been ongoing, the United States Exchange has been allowed, I think towards the end of this year we shall get an announcement, that the United States Exchange is now being told to have, they're now actually connecting their systems. So the depository of the central bank where we are processing our government bonds is going to be linked. There's going to be a link to the depository of the United States Exchange. What that means that even now our bonds will have, we can actually process orders directly through the United States Exchange. What remains to be seen is if the bonds and the secondary market will move on to the exchange. Because right now, if you're going to dispose of your government bond, there's a very opaque process, and the technical term for it is it's an over-the-counter arrangement, an OTC. In an OTC arrangement, the person who is processing your orders is actually earning what they call a spread. A spread is the difference between what you buy something at and what you sell it at. Now that's the difference that the banks make. Yeah. And lately, automation can help us. If we move the depository out, and maybe Ministry of Finance is a shareholder in that depository, and maybe private investors are allowed to invest in it, we can optimize it much better. Actually, it helps banks with risk management. There is a time where, and let me explain why. In an environment of high interest rates, the prices of bonds fall. Please listen, as I don't want you to lose me. There is an inverse relationship between the interest rate, that what you're going to be paid on a government bond, and its price. So a bond has a price, a coupon payment, an interest rate, and a maturity. Now, once you wake up in the morning and you have heard that Bank of Uganda has raised the CBR rate, the central bank rate, just no interest rates are rising. That also means that the interests in the bond market are rising. That means that the price is down. Let me explain something. Our bonds are priced in units of 100. Okay. When there's an auction and banks are bidding, or everyone is bidding to buy a bond, people are going to bid and say, I'll buy it at 95 shillings. Okay. A price. I'll buy it at 105 shillings. Now, the higher the price, the lower the interest you earn on that government bond. Now, these are technicalities, but please, if you're going in the bond market, they're very important. And I think we're trying to break them down today. The takeaway of what I'm saying, and we're going to go into the automation, why this is important, and why if you move the depository out, these mechanics make more sense in terms of risk management. And the pricing is one thing I'm explaining. A government bond has a price. That's one thing we're not told. What we always hear is interest rates, 14% cut off. That's what we hear. But that interest rate in the bond market, if it's 14%, it comes with a price. And the prices of bonds are normally calculated in 100 units. Okay? So the higher the price, the farther it spreads from 100, the lower the interest rate you're going to earn on that coupon you're going to get. So the bonds, and this is a global practice, not just Uganda. World over, there's an inverse relationship. Let me even just say, do this for those who will be watching. There's an inverse relationship between the bond price and the interest rate. So if the interest rate is going up and you've had at Bank of Uganda CBK, the CBR, has been an increase to 9.75 or even 10%. Just know a rising interest means that the price on that bond is lower. So the higher the interest, the lower the price. And the higher the price, the lower the interest. Now, for a person who is holding a government bond already, you will be making losses. What they call book losses. Unless, if you rush to sell in the secondary market, you make a loss. But for a person who is buying in a rising interest environment, it's a good time for you to buy because the price is lower and you earn a higher interest. You get? Let me go back to technology. That information asymmetry, that information can be made more available if the depository from the Bank of Uganda is taken out to the central bank, and maybe the Ministry of Finance becomes a shareholder. Private investors are allowed to come into it, so that if I'm going to buy a bond, the coupon payments, all those things are processed on that deposit outside the Bank of Uganda. It allows for risk management because now, if I know that the deposit is out of Bank of Uganda, we can actually deploy all sorts of strategies for risk management. For instance, there are things that the people in the markets do. But because it is being held by the central bank, there's little innovation that can be occasioned onto that depository. So now, the technology deployment in the bond market is going to begin with removing that depository from the center under the direct control. And besides, even illegally, it doesn't make sense. Because, and I've made this point to the people at the Capital Markets Authority, Bank of Uganda, Ministry of Finance, we have told them, even when we were drafting the private members bill for Honorable Nabita, these things were there. We told them that the person that sells to you the government bond or the security is not in charge of its safekeeping. Let me explain this. Remember back in the day when we bought shares from companies, we did not leave our share certificates with it.
No, we went with our share certificate.
Why do you go with it?
Because it belongs to me.
Exactly. Why is it that when I'm processing government bonds, the person who is selling me the government bond is holding the deposit, is holding my assets? They are mine. Yes, Bank of Uganda has an unlimited guarantee to make sure that in case something goes wrong, I'm compensated. But that doesn't take away my proprietary rights. So there are even legal issues. Now, if you do not streamline the legal issues, even the technology will not move along with it. Because lately, depositories are now even, they're going into things like tokenization. Now, there is a depository that is called it's called the DTCC in America. It's called the Digital Trust and Corporation. I think it's DTCC. I'm forgetting the extension, the full extension of the word, but it's called I think it's DTCC, Digital Trust and Trust Corporation. But you can Google DTCC. Now, DTCC is a depository that holds 24,000 securities or shares that are traded in the US markets.
Before we move to the DTCC, let me just, before we move to the DTCC, let's just have this sync to our listeners. You call for the democratization of the national depository.
Yes.
And your argument is that, look, if I buy from you, this is my proprietary interest. You should not be the one holding it. But also, most importantly, you are saying that this democratization allows Honorable Zijani, okay, who is one of our listeners, one ardent listener, that Honorable Zijani now does not need to pass through Equity Bank, does not need to go through NCBA, okay, to be able to also deal on behalf of others. And then the other thing you're putting down to sink to us is the bond market works in such a manner that's upward, downward. Simply saying, once this packet unit code 100, the moment you are shooting up, okay, once you're shooting up, it means the interest is dropping down. And the moment the price of the bond goes down, okay, it means the interest is shooting up.
So there's an inverse.
So it's an inverse kind of, these are technical issues.
And sadly, if you're going in the bond market, if you're going in the bond market, you can't avoid those technicalities. That is why we are trying to put this information out there. You go and do more reading, at least having been guided after the legal tech space.
You know, the reason why we want these conversations, I can tell you, Louis, when I had a conversation with Isaac some time back, and he said, my dream, is to see that every lawyer is able to get into these spaces that have been ring-fenced for a number of a few either firms and so on. I'll tell you, we are over 4,000 lawyers in this country. Yeah, on the role of advocates. But then, because these spaces have not been democratized, and because some of these spaces, people with knowledge skills like Louis, have not been given space to speak to us. So you find you have a one Norbert, you have a one Caroline, who do actually want to venture into this this area of practice, but has no idea, because these are things that are not taught at law school. And unfortunately, so these are things that you and me must learn from each other. And I really want to thank you. Ladies and gentlemen, we are having Advocate Louis Kizito Namwanja, an expert on finance matters, a consultant for fintechs, and is a top dog advisor for venture capitalists. You have your money and you want to invest in a startup, you have the right guy to call. And for startup companies, you have a guy you need to advise you, you have the right person on call. You want to go into crypto currencies, you have the right guy to call. Yeah. And at Diamond Advocates here, we believe that we should democratize this knowledge. We should not ring fence these opportunities. Yeah. If the client is going to come to Diamond Advocates and we can't handle that, he should be able to come here and say, by the way, I listened to your show. I do not know where Pentagon Advocates is, but that guy was on your show. I would want to do something on bonds, on bills, and we'll be very glad to refer. Yeah. So thank you really very, very much. And just right there, before we go to the DTTC, I know that DTTC is one thing you fills in the other one. Okay. I want you to your next phase of our conversation. Well, as you are excited about these capital markets, yeah. Our next phase, we want to look at what are the risks. A friend in Ghana says, look, I had all my money invested in these bonds, and boom, inflation hit. And the next time I was, I have a client called Felix Jerome from Zimbabwe. And he says, man, if there is one mistake I ever made in my life, was to pile my money in bonds in Zim. My guys who got the money and bought farms, man, are doing way good. Myself, boom.
In Zimbabwe dollars, eh?
Yeah, I had the Zimbabwe dollars.
Was it 2001, 2002, or right now?
I think 2001, 2002, when inflation hit like, crazy. So we'll be going to that space. But before we run there, Louis, take us about this tokenization thing. Thank you.
Now, the DTCC debate fits into the tokenization debate. When you look at, and before, let me give an example why the issue of a security should not be its custodian.
Yeah.
Remember when they sanctioned Russian central bank assets in 2022 on the eve of the war against Ukraine? The first assets that were frozen were the government bonds that were in the reserves of the Central Bank of Russia that were denominated in euros. And most of those were government bonds issued by France, other countries in Europe. Now, the custodian of those assets is a company called Euroclear. Actually, the way they froze Russian assets, the central bank assets that were the bond assets that were denominated in euros, they just targeted Euroclear. What the people in Brussels did, and I think Euroclear is in Belgium, What the people in Brussels did was they told Belgium, do not allow any, they did not seize them, but they froze. They made sure that Russia does not have access to them, and the coupon payments that the various governments in Europe are making, they are actually still kept in Euroclear, and they're not processed out of Euroclear to go to the central bank of Russia. And also, they immobilized the assets. Immobilization in finance means they freeze them, and you, who holds title to those assets, you can't access them. So it goes back to the principle that the issuer of the security, who is a government, is not supposed to be its custodian, because under the laws and the cardinal principles and of finance and securities law, the person who issues you that security doesn't sell it. That's why when you go to the Uganda Securities Exchange, the depository holds those shares on you, or he holds those shares and you process them there. But MTN, which is listed on that stock exchange, does not actually take custody of the depository in the Uganda Securities Exchange. Now, going back to the tokenization debate, and having clear that, why am I saying this? That when you look at the depositories that are out of the central bank and the evolution they're actually making and the leaps and bounds they're making in the treasury markets is much faster. One of them is tokenization. Look at DTCC, which is actually held in custody of 24,000 shares of different companies. There are 24,000 companies in the stock exchange in New York and also on the NASDAQ, I think. Yes. So most of them, they take the service of that depository called DTCC. Now, DTCC has actually has announced what they call tokenization of those assets that are dematerialized and are held by them. How are they going to do it? Now, remember, when you go to process assets or to go to buy bonds on the depository, that depository is holding them on your behalf, and they're recorded in something called a book entry format. Now, what that means is that there is a company that is a nominee holder of the shares you hold as maybe Tony or Louis. Now, there are two book entries. There's a book entry that the depository holds, and then there's another book entry for that other company that is a nominee on that depository. Yeah. So what tokenization does is that it shrinks the space, or it shrinks the number of intermediaries that are even operating on that depository. The depository participants, if at all it is done right, they can actually be taken out. The depository participants we have, like in Bank of Uganda's case, where they're only banks, the ones that have direct access at least. And then what tokenization does is that, I'll give you an example of what DTC is doing. I think the Amazon shares are recorded on that depository. Apple, they're recorded on that depository. All the General Electric, they're recorded on the depository. Now, if the issuer is telling DTCC, I want a tokenized form, what that does, it has the capacity to actually turn those shares into something called a bearer instrument, where you do not need a third party to be solvent to guarantee ownership as a third party. Let me paint an example of something called, there's a law in Switzerland called the DLT Act, the Switzerland Digital Ledger Technology Law. It has a clause that actually provides for DLT or Digital Ledger Technology issued securities. There is a company called, I'm forgetting the company. There's a company, it's actually resident somewhere in, I think, Brussels. They want to tokenize, but they're using that framework. What it's doing is that it has a ledger, and that ledger holds a register. Now, once a ledger is generated on a blockchain, and the register is actually registered on a blockchain, it can turn that instrument into an instrument which does not need a third party like DTCC to hold those shares for you. DTCC can still do it depending on how they want to structure their tokenization arrangement. Because I know they want to tokenize while keeping themselves in the loop. They don't want to throw themselves out of the loop. But what tokenization actually means is that it reduces your assets are recorded on a ledger, which is a blockchain ledger, and Louis can have direct access to that ledger and hold it as Louis without needing a trusted third party like a depository to hold the securities for you. So it eliminates the need for, so it turns, now for instance, let me give you an example of what a bearer instrument is. when you look at most people in their pockets, of course, if they're living if they're driving out of town, they should be having in their wallet something, a note, a bank note, maybe a note, a 50,000 shilling note.
Yeah.
Now, that is a bearer instrument because you physically hold it.
Yeah.
And if you're to take it from me, you have to grab me and you take it away from me. Yes. That's a bearer. Legally, those are bearer instruments. They don't need to be recorded by someone else, and for that person to be solvent for you to hold it. Now, now I can compare that banknote you have to your bank account. Okay. Let's go before we go to the token. Yeah. Your bank account and how it holds that note of yours. If at all they are put in your bank, if you deposit 50,000 shillings note in your bank account, the bank has to be solvent. It needs capital requirements, and it records your assets as a liability. Remember, public deposits in all our banks appear on the liability side of that balance.
Because we demand in the bank.
Exactly.
Yes.
It's a loan that you're given to the bank.
It's not the bank's money. It's my money.
Your money.
I need it. I get it anytime.
Exactly.
So it's a liability side.
It's a liability. Now, how do they have to save? And they take risk with that money, by the way, because if they want, they can deploy it in loans. Yeah. Now, what that means is that they need to be solvent for you to actually have that money on demand. Now, that makes that arrangement less of a bearer instrument. Okay. Unlike your money, which is with you, and you can dispose of it without even calling the bank. Yeah. For your bank account and your 50,000 shillings that is there, all 100 million, you need that bank to be solvent. So you're relying on the solvency of a bank.
You're relying on a third party, solvency of that third party.
Exactly. To make sure that you are paid back on demand. Now, what blockchain does is that it does not keep your assets, if at all they are bank assets, or even capital markets assets. Because in capital markets, remember, we have said those assets are kept as assets under management. You don't need a bank to actually guarantee ownership of an asset. Actually, what blockchain technology does is that it turns Lewis into his own bank for his own assets. Because of the way the book entry on the blockchain it does, the way the book entry is actually recorded. Yeah. You get? Remember, blockchain, what it does is it's a technology, and it is running on something called a distributed ledger technology. Yeah. Now, that arrangement means that if I am going to tokenize something, first of all, I'll put it on Rails, or what you call a platform that is not held by any intermediary. Look at the blockchain network and how people are holding their Bitcoin. Yeah. That is if you're holding your Bitcoin in self-custody, not on an exchange where you're sharing your private keys. There's something called a hardware wallet, or what you call non-custodial wallets, that can be enabled by blockchain-enabled instruments that are on the distributed ledger. Now, that distributed ledger allows programmers to use smart contracts and all sorts of things to make sure that assets can be programmed in such a way that they are held by Lewis, and they can be compatible in non-custodial wallets where Lewis does not need to call the creator of Bitcoin that where is my money, I need it tomorrow. But your private management of those private keys. Because remember, Bitcoin is also stored in very many ways. Yes. It can be stored on an exchange or a third-party custodian where the arrangement is not any different from a bank. Yeah. But it can also be stored through self-custody, because remember, the blockchain rails don't allow third parties to manage it. It's self-execution. Exactly. Yeah? Because even the ledger manages itself. Remember, the consensus algorithms or the consensus mechanism on the blockchain network doesn't allow trusting third parties. It's self-execution. It executes itself. It's because of certain smart contracts can be used on Rails, like even the Ethereum blockchain. Sorry, I'm going into these technicalities, but I hope I am trying to be as simple. So what your take home is, what blockchain does, if assets are kept as bearer assets, which it allows to, is that it eliminates the need for third parties. And if I am holding a tokenized bond, because remember, tokenized bond can be done on a distributed ledger technology. Now, that distributed ledger technology runs on a blockchain, and that blockchain allows programmers or Web3 developers to structure it in such a way that for me to access my Bitcoin, I just have to program it in such a way that if I hold my keys, I can access it at any time, and I don't need someone else to run that ledger as a third party. Yeah. You get what banks do is that they also run, by the way, ledgers. Though not blockchain ledgers, but book entry also. They have that ledger system, but they are managing it. It's a third party. It has to be solvent. Yeah? And they take risks with our money. But blockchain doesn't have a third party. It's a trustless system. Okay? It doesn't depend on third parties to manage it and maintain it. Yeah. So what that system does is that once you tokenize a government bond on it, it can actually be held the same way you hold Bitcoin in your private wallet, and you don't need to call a bank or a capital markets intermediary to do so. But my fear is, because we have very many powerful financial actors, the tokenization may not take the form of purely the Bitcoin nature, where I can keep it, and if I have my hardware wallet, it's with me, and if I have to access it, I can just get it at any time without calling Satoshi, who created the Bitcoin network. Yeah? My worry is because of these powerful individuals like DTCC, they're going to tokenize in such a way that they leave themselves in the loop. Yes, costs will come down, but they will still be high. Because I was telling someone recently, actually I even wrote it down here. I was talking to a friend of mine who I think works in BlackRock. BlackRock did something called tokenization of their money market funds. A money market fund, remember we've just described unit trusts. Now, unit trusts also take very many forms, sadly. I did not go into that. They are balanced funds, money market funds, all these. That's a type of a unit trust. Now, a money market fund, I think, invests in short-term assets, like maybe treasury bills, okay, let us say. Now, BlackRock went as a full measure, they took the step of tokenizing their unit trust, what they call the money market fund. Now, the money market fund of BlackRock that is not tokenized actually costs the customer less. Okay? But they tokenize in such a way that leaves them in the loop. Now, the tokenized asset or the tokenized money market fund, which is running on blockchain rails, because it leaves BlackRock in the loop, it's actually very many basis points more expensive because of the way they tokenized the asset. But if you tokenize in such a way that you leave it on blockchain rails without trusted third-party intermediaries, it actually becomes cheaper. So for me, the takeaway for our listeners is, okay, we have gone into technicalities, but this tokenization is a fancy way of saying that I am going to use the blockchain technology, and that blockchain technology is going to host the assets that are real-world assets, like even government bonds, like unit trusts, because they're slowly moving onto those rails. So the blockchain, if I have to explain it in a very, very simple language, blockchain, let us look at MTN. Okay, let me give an example of MTN, your mobile money. MTN manages your mobile money because it has a ledger that is centralized, that one accountant, okay, I can't say one accountant, but a few accountants within MTN are managing. Now, the difference with that ledger of MTN and the one we call a decentralized, please people don't lose me, don't lose me.
We have you.
The difference with that ledger of MTN, which is centralized and it's managed by some third party, is that the one of blockchain doesn't actually need a third party to make sure the transactions happen. Because the way the blockchain is designed is that it's immutable. If something goes there, it can't change. It has the consensus mechanisms of all the people who have nodes on that blockchain has to agree for something to move forward. So it's a democratized aspect of managing a ledger without having MTN doing double entry all the time, and they have to exist for it to happen. So in other words, these ledgers are decentralized for blockchain, and they have aspects to them that make it democratic. The one for MTN is centralized, and MTN must exist for transactions to be validated, to do reconciliations and all that stuff. So for me, I'm going to conclude this particular question of yours by saying that tokenization is an evolution in finance. And if depositories are actually managed in a way that the Euroclear, DTCC, they create more innovation, and we can see more innovation in the depository space. But if it's kept within the central bank, because what happens right now in our central bank is that it holds everything. The trading, it has to settle. The custody, the settlement, everything is within their ambit. But for countries that have actually democratized that space, taking it out of the central bank, it means that the people who are outsiders actually have a motive to make sure they innovate and stay ahead of time. That's why you see depositories that are not entirely under the purview of central banks are more progressive. They're actually more forward-thinking, especially when it comes to these technology-enabled aspects of transactions, facilitation, settlement. They're more forward-looking. So I would think that tokenization is evolving fast, and it's happening in the financial space. And if you look at BlackRock, the BlackRock example I've given you, their non-tokenized assets or their non-tokenized unit trusts are cheaper. But the tokenized unit trust of BlackRock is more expensive because of the way they did it. So we also have to be careful with how we tokenize and when we tokenize. Yes? There's tokenization that actually is cheap. But then there's tokenization that is very expensive because some trust intermediaries want to keep themselves in the loop and they don't want to embrace what? The permissionless or Bitcoin kind of arrangement. Yeah? So for me, that's how.
Wow.
But I hope it is clear. I don't want people to say wow when it is really not clear.
No, Louis, I would want to break this down this way in a very simple manner because Lego Tech Dialogues, we want this gospel to sink down. It's sometimes a complicated gospel, but we try as much as possible to simplify it. And for me, when you preach that in your school of thought and opinion, there must be democratization of the depository. Because in the current state, the Bank of Uganda is doing the custody.
And it excludes very many people.
And it excludes, because
especially who are not banks.
Exactly. It is having the custody, it is doing the settlement, it is doing the onboarding. I mean, it is a one-stop center controlled by one party. And I've always, when I'm discussing this this blockchain thing, I've simplified it like a primary school teacher from that angle. I've always told them, look at it this way. It is easy today to transfer, if President Isaac wanted to transfer his car now, okay? Because URA has adopted some bit of blockchain, okay? It means that using his account, he is able to get a passkey, which is sent on his email, okay? So it means that he's in control of that transaction. You get where I'm coming from? So using that passkey, he's able to share the passkey the other side, and a transfer will be effected. If I am transferring land, which is not our land system, which does not have any blockchain in its system, everything must be controlled by a third party we are calling the registrar. Okay? So that I must have a transfer form, I must sign on it. So what I'm saying is, if I am doing a transfer of land, okay, because there is a third party, I can take a week doing one what? Transfer. Why? Because the registrar is not around today. The registrar must sign. You get where I'm coming from? He must physically control the process. So I really agree with you, and I'm sure our listeners get where you're coming from. You're saying this tokenization, the blockchain enables you to control your own assets at your own convenience. Exactly. Just like I will be able to initiate a transfer of my car at midnight, and I will be able to get a passkey dropping in my email, okay? You get where I'm coming from? So that means that I'm doing a transfer late in the night. It does not matter the time.
And let me also add, maybe as a rejoinder, before we forget this aspect.
Yeah.
What tokenization also enabled is 24/7 stock markets. Markets that don't open at 8 and close at 5. That has been the standard practice. Even our Uganda Securities Exchange here, they open at 8, 9:30, okay, at most, then they close at 5. Now, recently, NASDAQ is the second biggest stock exchange in the world, in the US. NASDAQ, they applied for a rule change to their American regulators, and they allowed them to actually operate something that is equivalent to 24/7 markets. Now, because of the permissionless nature of the blockchains that they might use.
Yes.
People don't have to be deployed there because you're not going to work anyone for 24 hours. People will have to switch off. But now, because assets are self-executing and they have smart contracts within them, smart contracts are a coded way of, look at it as a contract, but it is in code. It is self-executing, okay? Because it's already been pre-programmed. So all these things can be enabled. Now, I just want to chime in there so at least we don't lose that point. So you can even do transactions. Because of tokenization, it allows for 24/7 markets. The danger is it gamifies investments. But that's a discussion for another day. But at least you have that aspect. Now, when you tokenize, the markets actually become self-executing. They run on rails that basically don't need a lot of human execution, which can even apply. You can work for 24 hours, maybe 1 off hour, and then 23 hours when they're just allowing all the trading going on. So I just want to just chip in and
thank you very, very much. And I think now I want to take you to the maram a little bit. You have Brenda, who is a salary earner, okay? Fears losing her money. And does not understand the risks that come with some of these capital markets authority, or what we are calling virtual assets, okay? And we have had conversations, we have had countries where, I'll give you an example of my friend Felix Jurumi of Zimbabwe, who said, you know, man, I had all this money in bonds, and then boom, you wake up one day and they're telling you, you know, the inflation has hit you real hard, okay? And that conversation has moved on for a very long time. It's like the chicken and the egg conversation, okay? So you find there is that gray area. Should I put my money in land in Masaka? Njiberenga muna etaka lyangendera bako ikasalirirawo, or I should put money in this. And because I do not know how these things of you wake up one day and your 1 billion shillings is equivalent to the 100,000 today. Now that you are here, kindly speak to our people. And ladies and gentlemen, we are listening to Louis Kizito, you know, an expert on finance and an advocate of the High Court of Uganda. My president will say, and all subordinate courts. Yeah, and we are discussing Legotech, rethinking unity trusts, treasury bills, and bonds. And clearly we are rethinking these things.
Yeah, we are.
And that's why we are saying, look, let us have the tokenization. Look, let us have the democratization. These are innovations that we are bringing forward. We are saying, look, can we have the automated KYC so that we make this a simpler conversation? Yeah. So I want to thank you for rethinking.
trying to rethink or pushing for rethink.
Pushing for the rethinking. So I would want you to paint a picture of David, who is a salary earner, but he's saying, wait, before I go into these things, this guy is only talks about the bread and butter, but what happens on those dry days when push comes to shove?
Now, okay, you know, in finance, you're not encouraged to pile onto one asset class and say, I have my land, it's 100 acres, and that's it. They encourage a lot of diversification.
Yeah.
Put some money in this, put some money in that, put some money in this. Because they all have their different risks.
Yeah, yeah.
And you cannot just pile onto one asset class and say, for me, I have land, because also land has its limitations, and we just discussed some of them.
Yeah.
You want to get some money very fast, the liquidity elements might not happen. But for land, it's inflation proof, its value keeps going up, and that's a bonus. But then also the government bonds are liquid. They also have their issues. Now, let me go into the risks of, first, in at least the Ugandan context of the bond market. Now, if you are a salary earner and you want to, you already have maybe your 10 million in government bonds and you want to cash out, I think you will have to be very smart to do that. normally for me, what I think, and this is my opinion, remember guys, this is not investment advice, only legal advice. If you want investment advice, go to your lawyers, go to your financial advisors. In my opinion, when you look at how the government bond market is structured, for a salary earner who's not very sophisticated in finance, you'd rather get that government bond. If it's a 5-year maturity, you run the whole mile. You get your coupons every 6 months when they're being paid out by the Ministry of Finance or with BOU, okay? Because by BOU in this market is a fiscal agent. Yes. That's what a fiscal agent does. It's an agent of the Ministry of Finance. So you rather hold that instrument till you are done with it. The 5 years, and then you get your principal. If you invested 10 million in the government, let us say bond of a 5 years maturity, okay, and you have coupon payments of every 6 months. And remember, we have discussed all these things of inflation, prices. And remember, that information is not quickly available to you. That information is, because of the way our market is designed, it's left to a very small set of people in the treasury departments of banks who actually don't even have an obligation to advise you when and when not to cash out. Because they assume you have your advisor. For them, they're just facilitating. That's what most banks think. And remember, treasury departments in this country are paid a lot of, by the way, the biggest earners in banks. I used to think the IT guys. I was wrong. The guys in the treasury departments who are in charge of these bond market issues, because that is also their territory. I remember banks are also piling on government bonds a lot. That's one asset class they are piling their money onto and leaving the rest of us to fend for ourselves. You get? So for me, having the information asymmetry in that secondary bond market, which you can use to cash out if you're a salary earner, I would think for you to do so, you have to be very wise, or you have to be a different creature of a Ugandan. Because of the kind of information that is kept. Because first of all, that market is not real time. Like the access to information is not real time. The way you go to the Securities Exchange and you want to find out the bid and ask price of the MTN shares, Louis can find that out. But in our bond market, it's different because our bonds are not on the stock market. Remember, they're exchanged through the arrangement of BOU, which is not on the stock exchange, where prices are public, where what they call the order book. Here, their order book is hidden. And because the treasury people in the treasury departments are paying a lot of money to make money, or also to rip you off.
I love the last sentence.
You run the whole mile of your government bond. And then because there you got your bond at the start, you have it for 5 years. At the end of the day, they will get you your 10 million back onto your account with the interest payments that come with it. Remember, these interest payments come every 6 months, every year. But your principal comes at the end of the 5 years. So for a salary earner who's not very sophisticated in these things, run that whole mile. In the unlikely event that your salary earner who's not very sophisticated and you want to cash out in the secondary market in Uganda, because of the nature of the depository and how it is held, this thing we're discussing, information is not readily available in real time. The prices and the rates, I know the rates are, we're talking about the inverse relationship of bond price and all that stuff. There is something called a Bloomberg terminal that is expensive, that for you to be an active trader in that market, you have to have access to that information. And subscription to the Bloomberg terminal is about 5,000 USD. So not very many people, because of the nature of our market. I remember even that Bloomberg terminal, okay, it has its issues. But for me, what I'm going to say is, if you're going to attempt to sell out before the maturity, remember, you can dispose them before your 5 years. Bonds also have that arrangement. That's called the secondary market, where you can say, guys, me 3 years are enough. Give me in the secondary market. That secondary market, that's where you cash out. Now, they make that cashing out has its mechanics also. And that pricing of the inverse interest rates go up, the prices go down. It's not real time to you. The banks might see it, but they may not give you that information. Because they also want to get what they call a spread. The difference between what they'll buy it from you, what you're selling it, and what they'll buy it from you, that spread. So the spreads, Bank of Ghana came up with regulations which was saying that the banks should not actually exploit people in the bond market above 1 percentage point, 1 basis point, which is about, I think it's about 100. A basis point in finance, it is like 0.5%. Okay. So, in other words, if they're selling you something, the bank is not supposed to benefit from a spread which is above 1%. But now remember, Bank of Uganda doesn't even have the legal mandate to make even those rules that are stopping, these banks from widening their spreads, because they actually do. So for me, okay, my take home is one of the risks in our bond market is the secondary market is opaque. And for you to be an active trader who is cashing out, you have to be very smart, or you have to get an advisor who also has that information, and you give him something, and sometimes it's complicated. That's one. Then two, land, you cannot pile on land all your life. Because in this world, you have to put some money in shares, put some money in unit trusts, put some money, because the risk matrix are different from all. And you imagine now, the other risk for bonds is they may not have credit risk, because remember, government can always print money and it gives you as a bondholder. Yes, we have seen that. As a bondholder, by the way, there is no credit risk, but there is market risk. Market risk meaning the prices go up and down depending on inflation, all those things. The secondary market goes up and down. You get? So those dynamics also make the bond market. And for our case in Uganda, the secondary market is very opaque. There's information asymmetry. So not everyone can participate fairly. So for me, my conclusion to your answer is, I don't think someone should just say, I'm going to pile on land and that is my life. No, diversification of investments. Because situations are different, and by the time that situation hits, maybe it will hit all your land and you'll be penniless. Or maybe you might want something and you can't sell the land, but you have some other assets which which are high risk, and maybe can earn you some more return. So diversify. I can't say land, I can't say bonds. Bonds are also very good because they also come with their advantages. Actually, the rates that bonds offer, I don't think that there's anything in Uganda that actually offers that 16%, 14% cut-off that we get. There are very few businesses annually that give you that kind of return. Though in the bond market, for you to make real money, you need to go there with real money. If you're going there with your 10 million, now for instance, let's be honest, if you're going there with less than 10 million and you want to benefit on that coupon rate, it might not be as juicy as you want it to. But when you go there with a 200 million, which has the capacity to move the market when you cash out immediately, because remember the bond market in Uganda's case, we have what they call, if you're going to enter there for the first time, there's something called a competitive rate and non-competitive. Now, competitive is something you're going to offer above 200 million actually. Because that one can push up those things we're talking about. You can bid because you're in the big boys that are playing. But when you're 10 million, you just have to set for whatever the big boys have set. So for me, the bond market, I would think it's a good investment. But you just, for a first timer, go there and park your money for 5 years. Until your 5 years are done, get your coupon payments every month. Then at the end of the 5 years, you get your 10 million. But in the unlikely event that you have an emergency and you want to cash out in the secondary market, you might suffer. You might suffer.
Thank you. Thank you very much, Louis. And for the record, Louis says, use this information as you deem it fit, but it's not legal advice. It's not financial advice. For financial advice, go to your financial advisor. For legal advice, come to your lawyer, Galanto Nekile here, Diamond Advocates, and we give you a fee note. Otherwise, for this information is for education purposes, and he's completely not liable. Yeah. But I can only guarantee that Louis is a financial expert. He's a consultant for fintechs. He has been in this space for a lot of time. He has advised government entities, sometimes by force, sometimes by choice, sometimes by request. So he's that passionate about this particular area. And it is, wow. It is 30 minutes to 10. And unfortunately, we can't go beyond this. I am going to open up the space for some questions. Therefore, go on your space and send a speaker request if you have something to ask. And I will entertain, I think I'll have 2-3 questions. Most of the questions you sent in your inbox have been answered already. So if you would want to ask a question, Louis is available for you. In the meantime, Louis, as we are waiting for people who would want to ask 1 or 2 questions, this is one special question I prepared for you. Different from what I normally prepare for others. Because the generic question here has always been, what should that young lawyer who wants to be a Louis tomorrow do to be a Louis? You know, a young lawyer with a big brain. That one we must take it. But this particular question is in this particular space. What is that? Lawyers who want to venture in this space should stop doing. And what is that particular thing innovators in this space should start doing? And what is that inevitable thing policymakers in this space should start doing? Over to you, Louis. It's your last padding question, and thereafter I'll be inviting the president, who is going to be giving us a closing shot. We have decided to have the big drum sound last.
Yeah.
So over to you. Thank you.
Thank you for these three questions. What should lawyers stop doing? Number one, mindset change. Let me tell you how I got exposed to these financial things and how I started drafting Honorable Navigator's Bill for capital markets. I got that inspiration actually as early as third year in Makerere University. One day, I think we had a session with I think the head of the, I don't know if she's still the head of the commercial law department, Professor Tarini.
Yes, it is.
She, on the sidelines, as a gentleman who had come to talk to us about Islamic banking. I think that was the time when President Museveni closed the university over a strike.
Yeah.
It was the last session, I remember. So that gentleman on the sidelines, I don't remember his name, but he had come to talk to us about Islamic banking.
Yeah.
Then by mistake, he was going out of our session and he got a phone call and was talking about government bonds. Then I asked him, but what is that? So it was not a discussion that we had in class, but was going out of class, and I think because he works in the bank, he was discussing a government bond. So I got interested in what government bonds are as early, I think, around third year. But this is what lawyers should stop doing is a mindset change. I think legal practice is beyond the conventional field. And legal practice is beyond, it's an ever-evolving field, but the law is one of those things that has a life of their own. Like you can wake up today and what you practice today is not, okay, I can't say it loses market, but it's not what is prevailing.
Yeah.
And even the laws themselves change to meet this changing time. Who knew we'd be talking about a virtual asset service providers law? Personally, I thought we'd be having that law in 10 years because of how slow we move.
Yeah.
But now that the virtual asset law is going to come, how are lawyers positioning themselves to take benefit of the virtual asset service providers that are going to come here to set up shop? So I'm thinking we should stop cornering our mindsets into certain areas and thinking that, yeah, land is the thing. Of course, land will always be the thing. But like we have to discuss diversification. So we need a mindset change, and we have to understand that law is one of those areas of practice or a profession that has a life of their own. They change. So we should stop having a small mindset. What I think the president says, linear thinking. President Semakade has that terminology uses for people who have that linear thinking, looking things in one dimension.
Yeah.
So lawyers in Uganda, we are very one-dimensional people. So I think the law society should help us be cross-dimensional. There are very many multiverses even within the law field itself. That is one thing we're not taught in school, and that's one thing that's not emphasized enough in our first 3-4 years of living school. And sadly, those 3 years determine a lot of how we think. So that's one thing we should stop doing. What should innovators think about? I think innovators should stop relinquishing the policy spaces to people like Louis, because even Louis has to make money at the end of the day and is not going to be shouting. Because me, at some point, I also stopped shouting with people at BOU.
Yeah.
For strategic reasons.
I hear you.
So for me, I think the innovators, number one, they should tell the Capital Markets Authority to regulate the private capital market space better. Because that's where most of their money comes from. Private capital markets, those are things of venture capital and private equity. And the way they regulate those things is stopping venture capital funds from setting up here. I'll give you an example. Just 2 weeks ago, I was on a call with some friend from Ghana. They want to do a tokenization project of Uganda's gold because there's tokenization of gold in Ghana. It's a very big project. Now, that person was once funded by a venture capital fund that was actually in Uganda. And it left they came here in 2008 and they closed up in 2023. But that venture capital fund wants to come back because for their own strategic reasons. So I had to reach out. They reached out to me for an opinion on whether they should set up. But their primary preoccupation was, we want to come to Uganda as people who are operating under the Tier 4 Microfinance and Money Lenders Act. They were here as a venture capital fund. And I also told them about these benefits we have that For a venture capital fund, you are tax exempt, no income tax, no stamp duty if you come here. But for some reason, they looked into the things and they're like, no, we cannot come back as a venture capital fund, even as registered, because now you can register as a venture capital fund. Yeah. So they want to come back here as a money lender that is primarily doing business lending to businesses. So I think the innovators should take up the more policy spaces. Yes, I know you are very busy. Web3 developers are busy coding smart contracts and make sure that smart contracts don't have bugs. But what point does it help you to have a smart contract on the blockchain that doesn't have bugs when the policy that's going to come up, for instance, virtual assets, your voices are not being heard, you're just waiting to code. At the end of the day, what innovators need is something called network effects in Uganda, where the ecosystem is vibrant enough so that if I set up in Uganda, there is someone next door who can connect me to a bridge loan in the event that, of course, banks can't give you loans if you're an innovator because that's high-risk business. So innovators are relinquishing the policy space to people who can also get tired. So be proactive. Don't just sit and say the government will do it, because our policymakers just sit and wait for you to put pressure. So rather the innovators, I know you're doing a very good job, but on the policy space, I think it doesn't make sense for you to code a good smart contracts, no bugs, and then you can't even deploy that smart contract in Uganda because Bank of Uganda has said that payment service providers cannot on-ramp or connect with mobile money issuers, mobile money companies. So the policy space, be more proactive. Don't get tired very fast, because they get tired. There are my friends who are tech guys and like, for me, I'm tired. I'm now going to DIFC of Dubai, the Dubai Financial Center. That's why now they're running too. Not knowing at the end of the day, you're going to retire here. So innovators, because they have a global mindset, they're like, Uganda, you are so slow, I am done with you. And yes, most of them are even Ugandan. So have a mindset of also making the policy front more favorable for you. Don't relinquish it to a few people, because when Louis will get tired, he has a license processing BOU of the payments. So he's not going to keep shouting with Dr. Goodness, I met him the other day. The head of payments, but the head of payments. Yeah? So then the last thing is the inevitable thing that we are supposed to do, or what is?
We're saying, what is that inevitable thing? Policymakers should start doing.
Oh, policymakers. Now that's my forte for now. But for me, I would say policymakers, I think we should be more forward thinking than we are. Yeah? When we're drafting the virtual asset service provider regulatory practice assessment, which is paving way for the draft and the framework, yeah. I told her, and the good thing, that is one law or the preparation of it that had very many regulators in the room. We had Bank of Uganda, we had CMA, we had Financial Intelligence, we had URSB, all the financial sector regulators were there. But for me, I told them, number one, let us not copy and paste all our regulations from Kenya. I'll give you an example. When you look at the Kenyan Virtual Asset Service Providers Law, there is a global player that actually bankrolled that entire process. So if you copy and paste what is in Kenya, Uganda is a smaller market than Kenya. You may fail to actually distinguish yourself and to attract the kind of businesses we want. Yeah. So our regulators, when it comes to drafting and reforming our laws, okay, yes, we can keep within the broader frameworks of the East Africa, but we don't have to copy, because remember, this big virtual asset service provider in the world, I don't want to mention the name, he bankrolled this entire process for his own interest, and he kept out a lot of innovators on the juiciest parts of the virtual assets crypto business. So if Uganda, you don't understand that concept or that background, that context, and you copy and paste, because most of our financial legislation, Capital Markets Authority, financial institutions, most of them are a replica of what is in Kenya. And for good reason, but I also think it's for bad. Because now what we're dealing with in the Capital Markets Authority Act, the bad regulation, the depositories that we're trying to move out of the central bank, it's because we copied and pasted from a market that had its own. The last example I'll give you in terms of being more forward thinking and not just copying and pasting from our neighbors. I'll give you an example of what we are seeing in the space of payments and fintech and the regulatory sandbox. The way the Kenyans designed their framework, Kenyans are, when you look at them, the people who go into the politics are going into politics to safeguard their wealth. Yeah. That is them. In Uganda, it's a little bit, it's a bit funny.
In Uganda, in Kenya, they go into politics to safeguard their wealth. In Uganda, we go into politics to get our wealth.
That means that as Ugandans, the Ugandan elite have we have a poverty of imagination. Yeah. We cannot imagine the impossible and know where they can take us. We want to know what is here. So our regulators are also not any different. So I'm thinking our regulators, number one, be forward thinking. don't copy and paste, because the world is moving forward. Now, as Uganda, we need to position ourselves also as a hub for virtual assets, crypto assets, so that is coming up. So don't just copy and paste. You need to understand the context of, for instance, why a stablecoin issuer in Kenya is being told to have 1 billion shillings to have a stablecoin. You are keeping out, there is a interest there, safeguarding, like I've said, people go into police in Kenya to safeguard. Now, for you, are copying and pasting that mindset here, it will work against you. So regulators, financial sector regulators, need to be more forward thinking. The world is changing, and I think they need to deploy what you would call the 4-dimensional aspects of critical thinking. Looking at things like lawyers who are one-dimensional, they should also be more clockwise, thinking in a more clockwise manner. So our regulators, the financial space, should understand that this field actually is changing. Like I said, there are 2 areas in the world that embrace technology ahead of other sectors: defense, military, and finance. When you go, if you want cutting edge technologies, you'll find them in the defense departments of major industrial powers, and their finance departments. That is Wall Street, the London Stock Exchange, the Paris. That's where you'll find them. So let us keep that in mind as regulators.
Ladies and gentlemen, we can't go beyond this. Thank you very, very much, Louis. Adam, please make the president a speaker so that he can give us closing shots. I think I would summarize this in the simplest manner. Louis says the lawyer, don't close your mind. Have an open mind and embrace some of these areas. And learning should not stop. You should keep, learning these new areas. And for the innovator, don't be like the Ugandan lawyer who sits at the back and does not want to join politics, but feels the politicians are daft. Yeah. The innovator, we are saying, please come and be part of the conversation. Okay, those Web3 coding of yours in a room somewhere, the law comes and it is actually affecting what you have been coding for the last 3-4 years. And Dubai may be very far for you. Yeah, and Dubai may be very, very far for you. So and for the policymakers, I think Louis, your critical call is, let us, at least for the first time now, avoid the copy and paste. Yeah. At least let's sit down. And I'm really I was very excited when that later came out on 8th May, which was inviting people, of course, people who really have what to talk about in this conversation of the legal framework for the virtual assets. And I think that is the right pacing. And I want to thank the policymakers on that front. Adam, could you send a speaker request to Isaac?
The participants in this masterclass are good food and expert Louis Kizito. Thank you very much for sharing unreservedly your knowledge from very elementary context on a number of things. On behalf of Baba, that it may feel lonely. Am I still audible? Being told I've lost connection.
No, you're audible. No, I can hear you.
Still audible? Oh, good. Yeah, it may feel lonely. It may feel confusing. You having to break down these things right now, but from our unreserved attention from beginning to end, take heart and take solace that the audience is committed and grateful. And Tony, thank you for being patient and as always the most devoted to our democratization and digital transformation journey, which we embarked on last year. I have been thinking a lot about change and change makers. And I realized that Lewis, in particular, fits the bill. It was exactly 5 years ago that I first reached out to him. I don't know where I got his number. But he was standing out as a prophet on a hill. Inviting us as a community to look here and there, telling us what's coming, telling us what's ahead, what's on the shores, explaining to us events and signs and seasons that we were living that we were not giving thought. Chairman has called it fighting with our I call them cathedrals of knowledge, wondering why they were not mismatch between the size of the cathedral and the number of believers in the church. Lewis has reminded every regulator in the sector, more than any person that I know, that they are falling short in the democratization of their services. And without numbers, the finance game is not is not successful. Everyone counts, every penny counts. So when I first met him, I told him, look, I hear you, and I don't want you to feel like the rest of us don't hear you. I had to reach out to him. I was a stranger, a complete stranger. I reached out and said, young man, I want you to know that we may not reply what you say, we may not do this, but we hear you. We do hear you, and we want. I gave him a pledge. I told him, I don't want you to. I can't do much. I don't have the envelope. You need to deliver this dream, for all of us. But on my part, I'll always have a 200K if you need. And I don't need to know the reasons why you need it for. Me, I believe I am in your church. I told him, look, me, I'll find you a prophet. I am my devotion is not in doubt. At any one time, 1 a.m., 3 a.m., you can always count on me as the guy who has a 200K for you. At that time, he was a very young man, so my understanding was that he needed data. He needed to have the minimum, the meal, data.
You're about to grow in your age
So
in
that
terms of knowledge. So
because I had been in that very situation some time back. And I said, look, me, I want to be able to support the hustle. I can't bring you the big bucks, the big break. But for your survival, I am one of your water carriers, and that's a very, very risky thing to talk to a person you don't know. But we've been very close like that. He has not been wasteful of a black check. But also he hasn't been very, I don't know, boastful, I guess, to not cash in. So I told him then that there is a frustration point because we're not a knowledge economy. Currently, I think it's a deal economy. Abantu badeal, abantu bagala new building from scratch and stuff. And so I told him there's a frustration point, and I worry that when it comes, it might crush you. So I suggested to him that corporate Kampala is Okugana. That may reject me. Not prophets are not really understood, outlines understood. I said, why don't you throw your lot in with the rest of us who are at the periphery of finance. So I explained to him, look, me, I have been in legal aid and social justice much of my professional life. And the only interaction with finance that I am quote unquote expert in terms of awareness is debt. I do read all these things, I read my Economist, I read my Newsweek, I read my I read a number of cutting edge publications on economics and finance. But debt is a subject that consumes me as a legal practitioner, as a policy watchdog. And all the things you've talked about today, Louis, they concern debt. When I buy a bond, when I become a unit holder or bearer, I'm a debtor. I'm a debtor. The unit trust manager is my creditor. The government is my creditor. So I suggested to him that the way I understand it then is that you are building a knowledge base around debt. And the majority of Ugandan finance today, debt is understood as borrowers. So people understand themselves as debtors only when they have borrowed money. So they actually don't understand that when I buy. But maybe they do. I don't know. I don't have the psychology within me. That's not how I do. But I asked him that, look, for me, the way I understand it is that the typical Ugandan debtor is the borrower from a bank. And your conversation is many years and miles ahead of them. So I suggested to him to sort of walk back a little and find us where we are. We are borrowers. Predominantly borrowers. And those who have kept us in that level, they are making killings. So Ugandan finance is centered around borrowers. Like that traditional, lowest common transaction of money lending. Now that's the marketplace. That's where you find sophisticated. We have not been so exposed. We are locked in this pressure cooker of lender and borrower. And yet, as I suggested to Louis, that the majority of the bar is very, our bar commercial court is really plaintiffs, borrowers. Court practice. Or vice versa. Lenders are suing borrowers, borrowers are suing lenders, and that's the dispute. That's the dispute that is going into arbitration and everything else. So I said, well, Louis, I don't know. That's the first suggestion I gave him about this. You may reach a frustration point in that the people, I don't know if I should say this on now here or something, but it's my prayer that you take a sabbatical.
I'm hearing. Are you? His network.
Back was it, and
Mr. President, have we lost you?
I think we have. Think we have lost our president. I think network issues, but yeah. So members, I think we have lost the president, and we want to thank everybody who has tuned in. I want to thank Adam for giving all the necessary support. I think for me, the president's position is acknowledgement of people like Louis Kizito. Louis Kizito is a young lawyer, but he has decided to jump the wagon and and join the how do I call it? The big lawyers league. He wants to describe himself as a young lawyer, but I think to every general rule there is an exception. So we will agree that Louis is an exception. He has outspaced. He has outpaced many of his colleagues, and I want to thank you, Louis, for that really very specialized interest in a particular practice area. And I also want to thank Senior Counsel Akasema Kade for identifying talent and giving talent support. And I think there's one line I always speak from him. This gatekeeping is not necessary. Yeah, we can sit here and describe ourselves as the award-winning tech law firm, and then we keep whatever knowledge we have to ourselves. But then at the end of it all, we have 48 million Ugandans, and you know what? 80% of these Ugandans don't fall under the unemployed population. They fall under the unemployed population. So I want to thank everybody, and we can't go beyond this. Ladies and gentlemen, thank you for listening. We look forward to having you next Thursday. Next Thursday, we will be having something about cyber security. And I can assure you, we have very, very, very knowledgeable panelists who will be joining us to discuss your data, to discuss your cyber security. You have no idea or no every time you are accepting this and that, what risks you are having. And so, ladies and gentlemen, thank you for joining us. And Mr. President, thank you for coming through. And the rest of our listeners, please, good night.